When traders, analysts, fund managers, speculators, punters, you, me, when we use the term Indian stock market, we are for all practical purposes talking about either the Nifty or the Sensex. After all, these two words identify with India's largest listed companies and present themselves as a key barometer for gauging the long-term health of the Indian economy. In this video, we shall examine the Nifty 50 in greater details, including what it means, which companies comprise the Nifty, how's the performance been, how can one invest in the Nifty 50, and a lot more. Let's begin. The Nifty 50 represents the weighted average of India's top 50 companies that are listed on the National Stock Exchange. In fact, this term Nifty 50 is a short form of the National Stock Exchange 50, but over the years it has been shortened even further, and today most people simply refer to it as the Nifty. So the Nifty 50 is a market index, and like any index, it represents a portfolio of investment holdings which happen to be the bluest of the blue chip companies. After all, we are talking about companies like Reliance Industries, the State Bank of India, Maruti Suzuki, TCS, Asian Paints, and 45 other industry leading companies. In fact, at the time of recording this video, these 50 companies together had a total market capitalization of over 1.25 crores, which represents between 55 to 60% of the market capitalization of all companies listed on the National Stock Exchange. The Nifty's importance in the financial markets also allows for a lot of innovation around it. For instance, a number of mutual funds use the Nifty as its benchmark. In fact, there is an entire ecosystem of products around the Nifty, which includes onshore and offshore exchange traded funds, exchange traded options, futures, and a host of other services, making the Nifty 50 the world's most actively traded contract. And speaking of an ecosystem, we have recently introduced a Learn section on the ET Money app, from where one can access our best videos and our best blogs to build upon the investing knowledge that you already have. So do download the ET Money app and do subscribe to this YouTube channel for more such insightful videos. Here's a question for you. The Nifty was introduced by the National Stock Exchange in the year 1996, which makes it a good 25 years old. So the question is, of the original list, that is the list of 50 stocks compiled in 1996, how many of those companies are still present in the Nifty after 25 years? To help you out, here's the 2021 list. And now you got to think, no wait, first you need to pause this video and then think which of these companies might have been in existence in 1996 and were significant enough at that time to be a part of the top 50 list 25 years back. Alright, welcome back, and I hope you have been able to count 13, because that's the number of companies that have celebrated 25 years of existence in the Nifty. And the usual suspects are all there. There's HDFC, Reliance, SBI, ITC, a couple of Tata companies, etc. But the bulk of the companies, a good 75% of them, have either merged with others or have simply lost relevance over time. In fact, here's a list we found on the original Nifty companies of 1996, and some of the names did come as a surprise. Names like Brook Bond Lipton, Ranbaxy, Arvind Mills, Ponds India, Colgate, Indian Hotels. And what's missing here are the many banks and IT companies that make up a bulk of today's Nifty. In fact, comparing the 1996 table with the 2021 table shows us how India has moved from being a manufacturing economy to a services one over these last 25 years. The point is that companies that represent the Nifty do change, and the index has seen almost 100 changes in its constituents over the last 2.5 decades. The Nifty has a very well defined and transparent methodology of selecting the constituent companies. In fact, the selection process can be examined in four parts: the universe of companies, the basic construct, the liquidity rules, and the rebalancing and reconstitution rules. Let's start with the universe of stocks, and it should come as no surprise that a company should be compulsory listed on the National Stock Exchange for it to be a part of the Nifty. More importantly, the company should also be available for trading in NSE's futures and options segment. In terms of the basic construct, the selected companies have to be in the top 50 companies in terms of their free float market capitalization. Now, understanding this word free float is important, and it quite simply means those shares or that proportion of the capital that is publicly traded. In other words, anyone can buy or sell these shares, and they are not blocked or restricted by company insiders like the promoters, strategic partners, employee welfare trusts, or even the government. A good example of this is Wipro Limited, where 73% of the shares are controlled by Azim Premji and his family, which makes these 73% shares inaccessible to the general public. So to put it in numbers, at the time of recording this video, Wipro's total market capitalization was 3,15,000 crores. However, its free float capitalization was only 27% of that, which comes to 85,000 crores. Which means from an index calculation perspective, it is this 85,000 crores which will be considered in determining Wipro's weightage in the Nifty 50. So different companies have a different level of free float, measuring from as low as 25% of the total market cap to as high as 98%. The third area of consideration when selecting Nifty 50 stocks is its liquidity, and this is where only those companies are considered whose trading volumes are always high. And the final selection component is the semi-annual rebalancing exercise that determines which stocks stay within the Nifty, which new ones come in, and which of the existing companies move out of the Nifty. This process happens in June and December of every year and is an important exercise as we want the Nifty to be an accurate representation of India's largest and India's finest companies. In fact, a case in point is how the sectoral makeup of the Nifty has changed over the years. For instance, at the time of inception, the Nifty had 0 technology companies and had just one private bank. Today, the top 10 companies within the Nifty have 4 banks in the private sector and 2 IT outsourcing giants in the form of Infosys and TCS. And speaking about sectors, the Nifty carries representation from 13 different sectors, although the financial and the IT companies make up 55% of the index. But it should not come as any surprise that the Nifty will have a very different form and shape another 5, 10, 20 years from now when we see new sectors and new companies emerging. Like there was no insurance 5 years back, but now it's there. Similarly, e-commerce and internet companies were privately held, but now we have a Zomato, which is likely to be followed by a Flipkart, Paytm, Byju's, and other new age consumer facing businesses. And while that happens and the Nifty continues to change shape, we have no doubt that the Nifty will continue to serve as one of the primary barometers of our country's prosperity. The Nifty 50 started its journey from a base value of 1,000 points and today is on the verge of touching 16,000 points. That's a CAGR of 11.7% over these 25 years, which is a lot higher than other asset classes like gold and real estate, which have delivered between 8 and 9% during the same time period. Now, given the nature of equity markets, the Nifty 50 has witnessed many ups and downs. Like in the year 2008, when the Nifty dropped by over 50% only to win back a lot of it in the very next year. In fact, more often than not, the Nifty has deviated from its long-term mean of 11.7%, but the most satisfying statistic here is that the Nifty has had only 7 negative years in the last 25 years, which speaks a lot of its utility as a long-term wealth building tool. Now, while this annualized return of 11.7% helps us, A more practical way of determining performance over longer durations is to be able to do so using the SIP mode. After all, investors like you and me, we just don't put in some lump sum money in mutual funds and forget about it for the next 25 years. We continue to invest, and mostly on a monthly basis. And if one had invested 10,000 rupees in the Nifty every single month from 1996 onwards, here's how the journey would have been. The first few years would have been a bit frustrating on account of the dot-com bubble, and it won't be until June of 2003 when your invested amount would actually start showing some sort of return. In sharp contrast, the period from mid-2003 until the end of 2007 was the rainmaker period for the Nifty, and your corpus would have zoomed from 9 lakhs to 64 lakhs in just 4.5 years. But what goes up needs to come down, and what followed next was a period of deep correction, quick recovery, and flat markets, which meant the Nifty took the next 5.5 years to register a new all-time high, which happened somewhere around August of 2013. And since then, the Nifty has seen the most amazing of market rallies, with our SIP corpus swelling to 2.07 crores as of June 2021. The point is that the Nifty, and for that matter any stock market, would have periods of ups and downs, and even this bull run has seen some hiccups like the 2015 Chinese market meltdown, demonetization in November 2016, and of course a massive 1100 points drop on March 23, 2020 due to the COVID pandemic. But the fact remains that a 25-year-old SIP on the Nifty motored along very well through these peaks and troughs, and your 30 lakh investment would have delivered a wealth corpus of 2.07 crores at a CAGR of 12.8%. Now the past is the past, and the real question is, what can we expect from the Nifty in the coming 25 years? Well, firstly, one can expect the future to be even bigger, with sectors like e-commerce, autonomous vehicles, logistics, artificial intelligence, robotics, defense, renewable energy, all rising to create the biggest companies of our times. And secondly, from a numbers perspective, the Indian GDP is expected to grow at around 5.5% over the next 25 years. This growth trajectory would make India an economic powerhouse by 2050, with 15% of the world's GDP, and one of the biggest representation of this power will continue to be the Nifty 50. There are two ways to invest in the Nifty. One, you can buy stocks in the same percentage as its composition in the Nifty, or option two is that you can invest in an index mutual fund that tracks the Nifty 50. The first approach, the stock buying one, is not really made for the average retail investor. It is expensive, it is hectic, and it's pretty complicated. For example, say I want to invest 10 lakh rupees in buying all the stocks that are there in the Nifty and in the same ratio. Now the weightage for one of the Nifty stocks, that is Shree Cement, is 0.4%, which comes to 4,000 rupees. But the problem we face here is that at the time of recording this video, one share of Shree Cement is priced at 28,000 rupees, which kind of puts us in a soup because fractional ownership of shares is not allowed in India, which means we cannot buy 1/7 of a Shree Cement share to stay within our 4,000 rupee limit. So we have to buy 0 shares of Shree Cement or 1 entire share of Shree Cement, none of which helps us in our objective of recreating the index. There are a few more problems like this when using the direct equity route, and this is why most investors prefer to use ETFs or index funds to invest in the Nifty 50. An index fund is a mutual fund which has only one job, that is to replicate the respective benchmark. So a Nifty 50 index would look to replicate the Nifty 50 and therefore will have a portfolio similar to the Nifty 50. I specifically use the word similar and not exact because, as we have in our tracking error video seen, that there is always some small variance between the index movement and the index funds movement. But net, a Nifty index fund will have the same 50 stocks which are there in the Nifty, They will be almost in the same proportion, and the performance of the index fund will be similar to the Nifty's price movement. More recently, consumer interest in investing via index funds has grown in India, and there are many reasons for that. Firstly, you can start your investment on the ET Money app at just 500 rupees a month and even 100 rupees with some schemes. Secondly, these funds have an SIP facility, and we discussed earlier in this video how great wealth can be generated with disciplined investing. Thirdly, index funds don't need active management, which keeps the expense ratio really low. And finally, index funds follow a well-defined system, which means there are no human biases with stock selection, and one doesn't need to worry about specifics like rebalancing, etc. The system does everything for you, and all you need to do is to be patient and enjoy the ride. And with this, we come to the end of this video. If you like this presentation, then do tap on that like button, and don't forget to share this video with your friends and family members who are just getting started with investing. Thank you for your time, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.